Imagine this. Back in 2017, two investors each started with $100,000. The first spent hours every week researching stocks, balancing sectors, chasing market trends, and building what looked like the perfect diversified portfolio. The second investor did something that almost seemed lazy. They bought just one ETF, closed their laptop, and simply let time do the work. Fast forward to 2026, and the surprising part is that the simple strategy came out ahead. That raises an important question. Have we been making investing far more complicated than it needs to be? Most people believe the more complex a portfolio is, the better the results will be. But history has shown that complexity doesn't always create wealth. In many cases, consistency does. The biggest mistake investors make isn't choosing the wrong ETF, it's choosing the wrong ETF for their stage of life. A strategy that makes perfect sense for someone in their 20s can become unnecessarily risky in their 50s, while a retirement-focused portfolio would likely hold back someone who's just beginning their investing journey. Your relationship with a market changes as your relationship with time changes. That's why in this video, we're building a simple age-by-age ETF framework designed around one question. If you could own only one ETF for each decade of your life, which one would give you the best balance of growth, risk, and long-term success? Let's start with your 20s. When you're young, your greatest investment advantage isn't money, it's time. You can recover from market crashes, ride through volatility, and let compounding work for decades. At this stage, maximizing long-term growth matters far more than generating income. That's why a U.S. large-cap growth ETF like SCHG stands out. It focuses on some of America's fastest-growing companies, businesses that typically reinvest profits back into expansion instead of paying large dividends. For young investors, that's exactly what you want. Instead of collecting small dividend checks today, you're allowing these companies to grow larger over the next 20 or 30 years. Of course, growth investing comes with higher volatility. Some years the market may fall sharply, but if you continue investing and avoid emotional decisions, those temporary declines have historically been part of achieving stronger long-term returns. Now, as you move into your 30s, life changes. A mortgage, a family, career responsibilities, and larger financial commitments make stability more important than it was a decade earlier. You still want strong growth, but you also want broader diversification. That's where an S&P 500 ETF like VOO becomes a compelling choice. Instead of focusing mainly on high-growth companies, you own hundreds of America's largest businesses across multiple industries. It provides exposure to technology leaders while also including financials, healthcare, consumer brands, industrial companies, and more. The result is a portfolio that has historically delivered solid long-term returns with slightly lower risk than a pure growth strategy. By your 30s, the goal isn't to chase the highest possible returns. It's to build wealth consistently while sleeping well during market volatility. And this shift in mindset becomes even more important as we move into your 40s. By the time you reach your 40s, your investment portfolio is often much larger than it was a decade earlier, which means protecting what you've built becomes just as important as continuing to grow it. This is where many investors start thinking beyond the biggest companies dominating the headlines. Instead of owning only the largest corporations in America, A total stock market, ETF like VTI, gives you exposure to thousands of businesses, including large-cap, mid-cap, and small-cap companies across nearly every sector of the U.S. economy. That broader diversification means you're not relying on just a handful of tech giants to drive your returns. If leadership in the market shifts over the next decade, as it has many times throughout history, your portfolio automatically adapts without requiring you to constantly buy and sell investments. It's a simple way to stay invested in the entire economy while reducing concentration risk. Then comes your 50s, a stage where emotions become one of the biggest threats to long-term success. Retirement no longer feels far away, and many investors make the mistake of abandoning growth completely in favor of high-yield dividend funds or overly conservative investments. The problem is that retirement could still last 30 years or more, meaning your money still needs to keep growing. Instead of chasing the highest dividend yields, many experienced investors focus on companies that have consistently increased their dividends year after year. That's where an ETF like VIG becomes attractive. It invests in financially strong businesses with long histories of raising dividend payments through different economic cycles, showing both stability and quality. While it may not produce the fastest returns during booming markets, it has historically helped reduce downside risk during difficult periods. That matters because avoiding large losses can be just as valuable as earning higher gains, especially when retirement is getting closer. The objective in your 50s isn't to eliminate risk completely. It's to remain invested with confidence, allowing your portfolio to continue growing while making market downturns easier to handle emotionally and financially. Once you enter your 60s, your priorities begin to change. For decades, your goal was building the biggest portfolio possible. Now the focus gradually shifts toward creating reliable income without constantly selling investments during market downturns. That's why many retirees prefer a dividend-focused ETF like SCHD. Instead of chasing speculative growth, it invests in financially healthy companies with strong balance sheets and long records of paying sustainable dividends. The goal isn't simply earning income today, it's generating cash flow from businesses that have demonstrated resilience through multiple economic cycles. For many retirees, that regular income can help cover everyday expenses, while allowing the rest of the portfolio to remain invested for future growth. As you move into your 70s, preserving financial independence becomes even more important. At this stage, predictable monthly income often matters more than maximizing returns. Some investors consider income-focused strategies like JEPI, because they are designed to generate higher cash flow through a combination of dividend-paying stocks and option strategies. However, it's important to understand that higher income often comes with trade-offs, including limited upside during strong bull markets and different tax considerations depending on the account type. That's why no single ETF is perfect for everyone. The best investment is the one that matches your goals, your risk tolerance, and where you are in life. The biggest lesson from this entire framework isn't that one ETF will outperform forever. It's that your portfolio should evolve as your life evolves. In your 20s, time is your greatest asset. In your 30s, consistency becomes your advantage. In your 40s, diversification matters more. In your 50s, protecting decades of progress becomes critical, and in your 60s and 70s, generating dependable income takes center stage. Investing doesn't have to be complicated to be successful. In fact, the simplest strategy is often the one you'll actually stick with for decades. If you found this age-by-age ETF framework helpful, let me know in the comments which ETF you would choose for your current stage of life. And if you enjoyed this video, don't forget to like, subscribe, and turn on notifications for more evidence-based investing content. Remember, past performance never guarantees future results, but building a disciplined long-term strategy is something that can benefit you regardless of what the market does next.